Welcome, entrepreneurs and investors. Today, we're demystifying the two most critical numbers in your financial toolkit, gross margin and net margin. Whether you are running a startup or managing an investment portfolio, understanding the distance between your revenue and your profit is the key to long-term survival. Most businesses fail not because they don't have sales, but because they don't understand their margins. In this 11-minute deep dive, we will break down exactly how to calculate these metrics, why they differ, and what they reveal about the operational efficiency of any business. By the end of this session, you will be able to look at a balance sheet and instantly identify where money is being made and where it is being lost.
Let's start at the top. Gross margin is the percentage of revenue that remains after accounting for the cost of goods sold, or COGS. COGS includes only the direct costs associated with producing your product or delivering your service. Think of raw materials, direct labor, and manufacturing overhead. If you sell a shirt for $20 and it costs $10 to make, your gross profit is $10. Gross margin tells you how efficiently you are producing your core offering. A high gross margin suggests high value add or strong brand power, while a shrinking gross margin often signals rising material costs or pricing pressure from competitors. It is the first line of defense in your profitability strategy.
Between gross margin and net margin lies a valley of costs known as operating expenses, or OPEX. These are the costs required to keep the lights on that aren't tied to a specific unit of sale. We are talking about rent, executive salaries, marketing budgets, insurance, and utilities. Many businesses have a healthy gross margin, but fail because their OPEX is bloated. For example, a software company might have an 80% gross margin because code costs little to replicate, but they might spend 70% of their revenue on aggressive marketing and sales teams. Understanding this middle layer is crucial for entrepreneurs who want to scale without burning through their cost reserves. Net margin is the bottom line. It is the ultimate measure of how much actual profit a company generates from every dollar of revenue after every single expense is paid. This includes COGS, OPEX, interest on debt, and taxes. If your net margin is 10%, it means for every dollar you bring in, you keep 10 cents. This is the figure that investors care about most because it represents the money available to be reinvested in the business, paid out as dividends, or saved for a rainy day. A thin net margin leaves very little room for error. A small dip in sales or a slight increase in costs can quickly turn a profitable company into a loss-making one.
The relationship between these two margins tells a story. If a company has a high gross margin of 70%, but a low net margin of 2%, they have an efficiency problem in their overhead. They are making a great product profitably, but they are spending too much on administration or marketing. Conversely, if both margins are low, the company may be in a commodity trap where they have no pricing power and high production costs. By comparing these two numbers, you can diagnose where to perform surgery on a business. Do you need to find cheaper suppliers to fix the gross margin, or do you need to downsize the office space to fix the net margin?
Context is everything. A good margin in one industry might be a failing margin in another. For instance, the software industry often enjoys gross margins of 80% to 90% and net margins of 20% or more. However, a grocery store might operate on a razor-thin net margin of just 1 to 2%, but survives on massive volume. When evaluating your business or a potential investment, always compare your margins against industry peers. If you are a consultant with a 10% net margin while your competitors are at 30%, you need to investigate your billing rates or your travel expenses. Use these benchmarks as your North Star for performance.
How do you actually move the needle? To improve gross margin, focus on value engineering. Can you source materials cheaper? Can you raise prices without losing customers? To improve net margin, look at your fixed costs. Can you automate repetitive tasks to reduce headcount? Can you renegotiate your lease? For investors, look for companies with operating leverage. These are businesses where revenue can grow much faster than expenses, allowing net margins to expand as the company scales. Improving margins by even 1% or 2% can result in millions of dollars in additional profit for large enterprises, making it the highest leverage activity for any leader. To wrap up, remember that gross margin measures your product's health, while net margin measures your entire company's health. Both are vital.
Your homework is to take your last 12 months of financial statements and calculate these two percentages. Compare them to last year. Are they expanding or contracting? If your margins are shrinking while your sales are growing, you are running faster just to stay in place. Stay disciplined, watch the gap between these two numbers, and prioritize profitability over raw growth. Thank you for joining us. Apply these insights today to build a more resilient and profitable financial future.